the benefits when we discovered REITs as a new asset class. Then last episode, we went back to one of the basic assets that we have, fixed income securities. Tonight, we are also going back to another traditional and exciting asset class, equities. The past few days after the recent elections have been characterized by uncertainty and fear. This fear has permeated not only in our consciousness, but also in our local financial and capital markets, resulting in the significant drop in the PSE index. Tonight, we will explore the basics, dynamics, and psychographics of investing in the stock market with our special guest.
But before we start, Sir Boyet, we would like to thank the IARFC Philippines, the Philippine chapter of the International Association of Registered Financial Consultants, for putting together this podcast. The IARFC Philippines is an association dedicated to the craft of financial consulting. The association is the sole organization authorized to conduct the RFC conversion courses as well as continuing education in the field of financial consulting. We are your hosts tonight. I am Kuya Ryan Daes, a registered financial consultant, a chartered wealth manager, and a registered estate planner.
I am Boyet Benavides, a registered financial consultant and a certified trust professional. Tonight's guest is a seasoned market practitioner and a very good friend. He has over 25 years of experience in the equities industry. He started as an analyst in local and foreign houses, focusing on banking, property, and conglomerates. He was later assigned to manage and lead the global credit and research groups by several global banks. He returned to Manila in 2011 to provide thought leadership in cross-asset investment strategy for one of the leading asset management and standalone trust corporations in the Philippines. Our guest currently sits as senior credit officer for one of the country's large and diversified domestic banks. Aside from his banking career, he's also a Finance 1 and 2 lecturer at the college here in the Philippines. So fellow RFCs and guests, let's all welcome Mr. Carlos Halandoni. Carlos, good evening.
G'day, Boyd.
Thank you
How
for
are you?
gracing our podcast.
Thank you.
Welcome to the show, Carlos.
Thank you.
So just to start off our session tonight, let's talk about equities. What type of animal is this? What are equities all about?
Okay, I think equities is an asset class, and naturally it's a bit more volatile. But because it's more volatile, you're also expected to get better returns. And the more successful investors in equities are the ones that really hold for a long time, right? Because it's like buying a house in real estate. You really benefit from the returns if you hold on for a while. Now, equities versus credit, what's the difference? Equities is taking ownership. Credit is having a liability or an obligation to pay someone an agreed amount of money an agreed amount of agreed time. And so that's the difference. In equities, you're taking ownership. The potential for upside is higher, but because you're taking ownership and the cash flows are not as determined, there's also a bit more volatility. And so I personally like equities because it's a good way to beat inflation. And for me, that's very, very important because especially today when inflation is so high.
Carlos, you mentioned that equities are a representation of ownership of a company. So it's a totally different asset class from fixed income, right? So
Correct.
So aside from, you mentioned also that aside from the capital appreciation, there could be income.
Mm-hmm.
And what are those called?
Okay, so the regular income stream from equities is called dividends. Okay, so some companies pay out the dividends every quarter, some companies pay it every 6 months, and some companies will pay it every year. What's the difference between a coupon, which is what you get from a fixed income, versus, say, equities? There's a big difference. A coupon or is basically an agreed amount that the buyer that the creditor will actually receive from the borrower every say every month, every quarter, or every year. Okay, so we know, for example, that every year, if I lend money to you or me as a bond investor, I'll say, I said Jollibee or Nayala Land or an SM bond, I'll get 3% or 3.5% every 10 years. Okay, equities is different. Dividends, on the other hand, is your share of the profits. So since equities is buying a stake in a company and that company will declare its income, will share its income to its shareholders rather than reinvest it in the company again. Okay. So because I'm a shareholder, it could be 0.5% or 0.1%, it doesn't really matter, or 5%, I'll get the commensurate equivalent in the dividends declared. Okay, so if the company generates 100 million of profits every year, and this company declares a 30% dividend, so 30 million will be available to all shareholders. And since I own hypothetically 1% of that, I'll get the 1% equivalent. That's basically it. So a dividend it could be high, it could be lower, it could be equal to the yield on a coupon, but you don't know. It really depends on the fortunes of the company. And that's why, unlike bonds, where you look at the ability to pay, in equities, not only do you look at the ability to pay, but you also look at the ability to grow the income every year.
Very nice. So you mentioned quite a lot of things on why investors should include equities in their portfolio. Aside from those things, like it can beat inflation, it can grow faster than any other asset. What other things should investors consider, or why should they consider? What other reasons would compel them to perhaps include equities in their portfolio?
Okay, generally speaking, equities, generally speaking, will give you a return of about 8%. All right, generally speaking.
Very nice.
On a given year. Okay, versus say a bond or say a money market fund, right? A money market fund will give you 1.5, maybe 2. A bond fund will give you maybe 3.5 to 4 or 4.5, depends on the movement of interest rates. Equities generally will give you 8, but there'll be times where it's higher than 8 or lower than 8. There is no predefined return. And so if I'm an investor, I would use equities to supersize the returns of my portfolio. Now, how much returns, how much equities I will have really depends on my risk appetite. I could have it all in equities, but if I can't sleep, then that won't be constructive, right? But then again, if I only put so much in equities, maybe that's the only thing I can absorb, because if I'm really an FI investor, I really don't like my net asset value or the value of my portfolio going down. I'm not used to that. I'm used to buying something, holding it on for 5 years, and getting 3.5 to 4% every year. But if I want to live on the wild side just a little bit because I want to boost the returns and diversify the portfolio, okay, I will put a bit of equities. Now, so I mentioned a couple of concepts there: higher return, higher risk. But there's also the concept of diversification. Generally speaking, okay, what you want in your portfolio are asset classes that are not moving in the right direction, in the same direction. Okay, so you want a diversified portfolio. So what does that mean? Okay, sometimes even in a rising interest rate environment, which is where we are today, bonds won't do very well, but equities might do very well. So what does that mean? It means that the overall return or the volatility of your portfolio can be managed by having a bit more equities or a bit less bonds or a bit less equities and a bit more bonds. Okay, so I've given you two reasons. One, in line with what I said earlier on, equities will give you a higher return but more volatile, but it will give you the opportunity to beat inflation. Number two, okay, it's also an opportunity to diversify your portfolio. You don't want it all in bonds. You don't want it all in peso. You don't want it all in GS, and you don't want it all holding on to, say, Ayala Land paper or all SM Prime paper. You want it diversified because asset classes behave very differently depending on the financial conditions. I hope that helps.
Very helpful. Thank you,
Thank you,
Carlos.
Carlos. You mentioned previously that stocks are mostly influenced by the earning capacity of the companies, which they distribute as dividends. So, what would be the like? What should we be looking for in choosing which companies we should be buying in the stock market?
Okay, so let me clarify that. For the most part, I will buy a company because I am comfortable in the management. I am comfortable in the management's ability to give me decent profit every year. What is decent profit? Decent profit is I take the cost of funding and I will put a return on top of that. Okay, could be 8, could be 5, could be anything. So the ultimate goal of management is to beat the cost, the blended cost of capital. It's a combination of debt and also equity. Okay, so when I look at a company, I look at the management and its ability to actually adapt to the evolving marketplace. So it could be, is it real estate? Its ability to adapt and sell and create value when they take a piece of raw land. If it's food like Jollibee, its ability to actually sell more products, both offshore now and locally. And let's say it's a grocery operator. Its ability to actually generate higher returns relative to its cost of funding, okay, by determining, okay, which part of the Philippines am I gonna put up the next grocery branch or grocery store. So really, when I'm looking at equities, because I'm gonna be in it for the long run, I need to be comfortable with management. Management's ability to generate income every year, operating income, and beat its cost of funds. Okay? So it starts with management, and then we look at how they evolve or how they determine the next move forward and how they're going to generate income in the short and medium term. That's basically it. Now, you could have a good company, but actually still see the value of its share price fall. Okay? That's not abnormal. Now, I'm not saying just because you have a good company and good management and you're comfortable with it, that it will always be in a straight line. The stock market is also a function, remember what I said, of the cost of funding. And so if interest rates are going up, the cost of funding is going to go up. And so the demands on management on the whole will also go up. Its ability, remember that credit or access to funds is an input to the business. All right. So when interest rates go up, right, the cost of funding goes up. The expectation is, or the expectations of investors, is that the profits will also go down because more and more of the profits will be used to pay off higher interest rates, or the outperformance relative to your cost of funding will also be lower. And so stocks do very well when interest rates are falling and they don't do as well when interest rates are going up. Now, okay, if you know a good company that is managed very, very well, okay, like our blue chip companies, okay, and it's falling, but you know in the next 5 to 10 years, these companies will still be the most dominant companies in their segment. So as it falls, because interest rates won't remain high for very long, okay, I will start picking it up. I will start purchasing these stuff because that's an opportunity. The market's giving you opportunity to actually buy more. Okay?
Great.
Great.
Well,
That's exactly the same. I mean, you practically described our situation now, where you see the market going down below the 6,500 level, and we still have good companies that we expect to be delivering good profits within the next few years. So that would be the signal or the opportunity for us to buy in to select companies.
Absolutely, Boyet. I think this is a great opportunity, and we have a. There was a bit of uncertainty probably a couple of days back because of the election, right? But to be honest, the recent developments the past couple of days after the election have been quite comforting. We've seen mock cabinet appointees, and to be honest, the names are very, very familiar. And these are some of these are members of the Makati Business Club. Some of these are members of the academe, and some of these you expect are also part of the inner circle of the Bongbong Marcos group, which is to be expected because, like any administration, you have the administration. They will protect what's critical to their self-interest, but at the same time, they will also protect the interest of the public, and also the private sector. And you can clearly see that in the mock cabinet appointees. The other thing that's also comforting is that you're starting to see now a lot of international leaders come out and support the soon to be proclaimed Bongbong Marcos administration. And to me, that's very, very important because our assets, especially equities, will not flourish if foreign investors uh, do not view it positively. Because, like it or not, our savings are not enough to actually optimize the value of our companies. We just don't save enough, right? So we have to rely on foreign savings so that the value of our companies are maximized. And so the fact that Joe Biden, Xi Jinping have come out and said that we support the process, the recent election process, and the outcome is a very comforting seal of approval for foreign investors. So, in my mind, yes, the peso should weaken, but it's not going to weaken because of the recent administration. It's going to weaken because, as an economy, we're going to have to import more than export as our economy bounces back to pre-pandemic levels. And so, to your point, Boyd, this is a great opportunity to actually pick up some names that have been oversold, rightly or wrongly. And some of these names, like Ayala Land, for example, is very cheap. You have Assam, some of the banks are very cheap, trading below book value. And these are the same names that will do well when the foreigners come back with gusto, I expect, the next 6 to 12 months.
wow. Those are great points, Carlos. Now, you know that I am part of the insurance industry, and of course, people would be asking. Sometimes we would push that it's better to leave the management of the funds to the experts.
Yeah.
Some people have this the acumen to manage their own funds or their own assets, but some don't. So should we do direct equity investments or just invest in equity linked funds?
I think for most people, they should do equity, they should leave it up to the professionals. Okay. And that's because most people don't really have the time to actually look at the stock market every day. And even the professionals themselves, and if you speak to some of the individuals who do rather well, they'll argue, well, the professionals, yeah, they're good, but they're not as good as me. Probably so. And so even the professionals with all the access to all the resources that they have, and that's all they do, okay, they still are not great. They're still they're good, but they're not consistently great. And so, what about you as an individual? That's going to be even harder. Okay. And so I think for less than 50 base or for less than 2%, right? Why not leave it up to the professionals to actually manage your funds? I'm more than happy. I mean, if you lease out, if you sell a house, okay, the owner of the house will give 3% or 2% to the broker. If you lease a house, the landlord will give the broker half of 1 month's rent. What are we really asking for here? It's not 1 month's rent what we're asking for. We're asking for, less than 5% to manage your funds. So I think that's a bargain, considering what you're getting. So yes, for those that have time and they know how to read financial statements and look at the company news day in, day out, yes, by all means, and you're quite successful, by all means, you should manage the funds directly yourself. But for most people, we're too busy looking after our families and looking after our jobs. Let's focus on the things that we know to do, we know how to do, and leave the experts for less than 5%, okay, to manage the funds. I think that's a worthwhile feat.
And then just to add to what Carlos said, the funds offer greater diversification at a lesser amount.
There you go.
Like when you buy PLDT, I mean, if the minimum lot is like 10 shares, then you have to fork out 10,000. With some of the funds now, you can buy for as low as 1,000 or even for as low as 500, and you already are diversified across different sectors.
Not only that, boy, to your point, you can even buy a diversified fund using dollars with not a whole lot of dollars to be invested. I mean, that is phenomenal. I mean, I didn't have that when I was younger. I'm so glad that we can offer it now.
Mm-hmm. That's a very, very good development now that we have diversification offshore. We have diversification across regions. We have diversification across asset classes and across currencies as well. So that's why when we look at stock investments, we're not limited just to common shares. There are also preferreds and also REITs. What about REITs, Carlos? How different are these from your plain vanilla common and preferred shares?
I like REITs. I like REITs in the Philippines because the companies that have issued these REITs are actually very sound, and they do look after the minority shareholders. I like REITs because it's not as volatile as common shares, because it's not as liquid, meaning to say it's not as traded by both foreign and local institutions. So a retail investor can really hang on to it and not expect a whole lot of volatility. More importantly, I'm almost getting like a common share return. It's like the one I really like at the moment is a REIT, for example. I can get at least an 8% return. Now, the other thing I like about it is that it's liquid enough, unlike a preferred share, which is which is not as liquid. So it's going to take a little bit longer to actually unload my holdings. So via REIT, I get a combination of almost common share returns, but not the same amount of volatility as a common share, but liquid enough, more liquid than preferred share. I can go in and out as a retail investor whenever I want. So, yeah, I'm extremely supportive of REITs. And there are at least a handful of REITs now, and I expect more REITs to be issued in the coming years.
when we talk about stocks, we always equate it with volatility. What should be an investor's attitude towards volatility? We see like now very wild swings in the market. Should we just
Right.
jump ship when we hear bad news and when the markets turn bear,
Yeah.
do we join the bandwagon when
Yeah.
we see that the market is going to head towards a bull run?
Mm. Boy, to be honest, the best advice I can give people, and I sometimes I don't follow my own advice because it's very hard to do, is to just take out the emotions out of investing. All right. Now, the ideal situation is that we buy high, we buy low and sell high, and we sell high and buy low. But in truth, that doesn't really happen. What happens is that when it's going up and it's high, you buy some more because you think it's going to go up some more until it starts to fall, and then you start to panic. And when it's falling, you don't want to buy because you think it's going to fall some more. And then next thing you know, it's already going up and you missed it. And so the best thing to do, and I'm so sorry if I sound extremely boring, but this is what financial planners would like to suggest, and there is actually good reason why you should, is that we should do cost averaging. Take out the emotions and just buy the same amount, all right, every Friday, every second Friday, every Friday, last Friday, whatever you want, all right, and let's spread out your purchases. Because over time, right, over time, okay, and I mean more than 5 years, you should see that your portfolio will move very, very nicely, taking advantage of episodes of low prices and also episodes of high prices. And so, in my mind, the volatility should be welcomed. What I don't like is volatility that will undermine the credit of the companies that we like. We're not there. Okay, so let me explain what does that look like. All right, because people ask me all the time, and pardon me, let me explain this for 2 seconds, for 2 minutes. When do I panic? Right? When do we panic in stocks? Right? Because we panic in stocks. Let's think about the last time we had a proper, okay, sell-off in the market. And I mean a proper, that was a sell-off that lasted more than 3 years. 1997. Okay? And so for most of you that weren't around, let me describe the scenario. A whole bunch of companies borrowed in dollars. They didn't have any pesos. They borrowed in dollars because it was cheap to borrow in dollars. Right? It made sense. The peso was always strong. Okay? And so what happened was, all of a sudden, somebody said, hey, there's no reason why the peso should be this strong because we're importing a whole bunch of stuff from overseas, then money being repatriated back to the Philippines. And so the peso went from like 20 pesos all the way to 50 pesos. And that happened in a span of days. And so money started moving out. All right. And so the central bank, what they had to do, and I mean days, not months, okay, it went from 20 to 50. They had to raise interest rates. And so they raised interest rates from like 10 all the way to 20, 25%, okay? And that absolutely killed companies, okay? And I'm talking about days, all right? And so what happened was that companies, all of a sudden, not only were they selling less, but their financial bill doubled, right? And the amount of liquidity required to service this debt also doubled because rates went up, because the government had to protect the currency. Okay? That is a scary moment. We are not there today. Okay? We are not. Even in all these, how should I say, the elections recently and high inflation and the Ukraine war, okay, what we're seeing is a gradual depreciation of the peso. 2.5, maybe 3, maybe 3.5%. We can absorb that. What we're seeing is that the interest rates moving up very, very, very slowly. Okay, we're not talking about from 10 to 20, 25% in a matter of days. Then the business can adopt, right? And so, yes, it should move up, but as long as it's moving up in an orderly fashion, not a one-time, big-time fashion, okay, then it's fine. Okay, and uh, so I'm not very, very worried. I don't think there'll be a credit event. I think, to be honest, the worst is over, right? So if the worst is over, we have a new administration, right, and it has support from the foreign countries, the other sovereigns, and the government is very, very careful in raising interest rates as the pesos very, very slowly depreciates. I think this is a great opportunity because we're coming from the pandemic, and so the economy should start to bounce back as it goes to normal, right? Where some of us, a lot of us, are going back to church pretty soon. Our kids are going to go back to school, all right? So some semblance of normality will come back. The traffic, unfortunately, getting worse again, right? And so, yes, the price of oil is extremely expensive, right? But you know what? That's not gonna be there forever, right? And so, and as a country, we can absorb that. We can absorb that. And so, I am very, very happy to see the stock market contracting below 6.5, as though it said, because in my mind, I hold for the next 5, 6 years, and this is an opportunity that I won't see again in the next 5 to 6 years, right? Names that I can sleep well at night with: Jollibee, BPI, Ayala Land, Globe, PLDT, ICT, SM Prime, Robinsons, etc., etc. There's no credit event, right? So that's where we are.
That's where we are, and that's opportunity for us.
So the market
Absolutely.
is cheap right now, Carlos.
It is cheap. It's like a midnight madness sale, right?
Uh,
It's cheap. If
you
I told
mentioned
if I told you Ayala Land was going to issue a bond, a 3-year bond offering 4%, do you know how quickly that thing's going to be taken up? We're talking about 3 days, right? People are willing to hang on to it, right? I mean, or an SM bond, a Boitis bond, or Robinson's bond. If you're willing to hang on for 3% for 5 years or three, why not buy stocks? We're coming from a point in the earnings cycle that's low. We're just coming from a pandemic, and that's going to recover. So, yeah, let's go for it.
very nice. Thank you so much, Carlos. Uh, you mentioned about recovery and bouncing back. Of course, we're not expecting that all sectors would benefit from this, especially with the new administration and the new globally connected economy that we have. Which sectors do you think would benefit most? First, with this new administration, with then with the opening up of economies worldwide, and perhaps sectors that would really grow in the next 3 to 5 years moving forward.
All right. So, let's look at sectors, regardless of which administration, that'll do well. This country is 70% consumption. So, you got to like consuming companies that are locked into consumption. The proxy for consumption in the Philippines, rightly or wrongly, is the SM and SM Prime group. The malls, the grocery, right? The department stores. So they haven't fallen very much. And so in a re-rating environment, that will do well. Jollibee, yes, there's been a lot of fanfare about some of the purchases they've made offshore. But let's face it, Jollibee is still beating the pants of McDonald's and locally. And when people return to normal, people will still eat their chicken joy and their hot dogs and their burgers. All right. Now, in terms of what I think will do well under this administration, So I think we should be buying companies um, that are in tune with infrastructure build out. If you remember, under the Ferdinand Marcos administration, where the public sector was really spearheading a lot of the investments, they did a lot of infrastructure spending. Okay, and so they did the LRT1, they did the Manila Film Fest, they did the toll roads, right? They even did the power plant, the nuclear power plant. Of course, we know what happened to that. I'm not saying that's so. I think this administration similarly will also be focusing on build, 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 right? So probably not so much public sector, but more private sector. But they will do a lot of build, build, build. And I think that'll do us well because I'm sure his advisors will also say, please do a lot of, let's continue the infrastructure momentum that we've seen during the Duterte administration. And I think he will be amenable to that because, as I said, as a family, even his old man, that's what they did. And so we should be looking at companies that will do well in a build, build, build environment. DMCI, for example, maybe the banks because they have to fund that build, build, build rollout. If you and also maybe San Miguel and Metro Pacific, okay, because they tend to be very active in the build, build, build programs. So infrastructure, consumption, and the third one being trade, but more like ICTSI because global trade's going to pick up.
Being like financial advisors or even for our own personal investment portfolios, how do we now consolidate all the things that we've learned tonight so that we can help our clients? We can also help ourselves in terms of making our portfolios resilient and robust to be able to generate the returns that we want for the next, like, what, 5-10 years?
Okay, that's a great question. I think we need to first and foremost go back to the basics. When we do financial planning for our clients, we have to basically first assess the risk reward profile of our client. That's very important. And I've discussed that. Yes, equities is exciting. Yes, it will give you better than bond returns. And yes, it provides the opportunity to beat inflation. But we also have to be cognizant of the risks associated with equities. After all, you are taking ownership and you are not taking credit. Because you are taking ownership, you are more liable to the fluctuations in the earnings of the company. And that can be affected by many things. Number two, I also espouse the importance of diversification, right? Once we know the risk profile of the client and the target, let's diversify the portfolio so that we actually minimize the volatility, right? Because most people don't like volatility. They don't really see it the same way as we do. Yes, I said cost averaging to take advantage of volatility, but most people don't really like taking losses full stop. And so let's try and help them by matching the right product and diversifying the portfolio to meet the client's risk reward profile. Finally, we should also encourage clients to actually seek financial or professional help. Managed funds versus direct funds, hands down, managed funds any day. Because as much as clients will say they have the resources and time to actively manage their portfolio, in reality, that's very, very difficult to do. And for less than a measly sum, they get the full suite of support, right? And the protection in their portfolio. I think that's extremely invaluable advice that you can give them. And finally, the last thing that I think we could give our clients today is just not to worry about the change that is now happening in our economy and in our country. Yes, change is here, and yes, it has come in a way that is not largely expected, right? We now have a new chief executive in Philippines Inc. And it is our job as a stakeholder of Philippines to make sure that he succeeds, right? And yes, there are many doomsday scenario out there and many people are naysayers. But at the end of the day, the international community has already accepted, okay, our new chief executive. And I think it's about high time that everybody toes the line, accept the reality, and let's really make a go of it. Needless to say, if there are some hiccups and bumps and something is not acceptable down the line, then let's deal with it down the line. Right now, we should be completely, all right, supportive and completely accepting of the reality. And let's really make our country better than it was before so that we can look after the poor who, at the end of the day, is like you and I, are also looking for a better life. And so while people are asking for better retirement returns, the poor are just asking for a better life. I strongly, on that note, my final word, the final word is this. It is better to be in the know than to be the last to know. Okay? So use this opportunity to be in the know. There's plenty of good advice out there. There's really nothing that I said that you don't know, but I want to give you the comfort, all right, whatever comfort, my 2 cents worth, that what you know is actually quite good enough to hold the hand of the client and make sure their returns in the portfolio are optimized. Okay?
Thank you. Thank you very much, Carlos, for spending the night with us and sharing your thoughts, your experience in the markets. And as you said, change is not necessarily bad. We should be accepting and we should be embracing change and moving forward and making sure that our decisions are aligned with that of seeking for a better future, a better life. Thank you very much, Carlos, for.
Thank you for the opportunity, guys.
Carlos, we learned a lot tonight. Definitely. Again, we thank you so much, Carlos, for giving us a very generous amount of your time. I know how valuable it is. I see your passion for helping out and educating people. I hope hindi ka magsasawa. Sana we can invite you again. So, now, we have another episode coming up, guys. So, what to expect? We'll be talking about hedge funds. Kasi we've been talking about traditional assets. So, we've talked about this in a previous season, but let's bring it down a few notches so that we get to learn it more or know about it more. Ano ba tong hedge funds na ito? So, we hope to see you again on June 13. That's the second Tuesday of June. For our public courses, please do check out our Facebook page, IARCPH. Just search it in Facebook, you'll find it there. And for those people for those who took courses before and would want to graduate this coming August 2022, you may join the RFC refresher course. Announcements are also on the Facebook page of the association. Please do check it out. And again, I would also like to remind everyone to renew their membership, of course, so that the association can continue to provide services like this and provide us continuing education.
Our podcast episodes are shown every second and fourth Tuesday of the month. That's why it's important to follow us on Facebook. Episodes are pre-recorded and are broadcasted through Facebook Live. So thank you, everybody. Thank you, Ryan, for